All right, everybody. I want to give you a really quick video today on paying off a house early. Now, if you're watching this today, and I'm going to actually unshare this really quick. If you're watching this today, I want to share with you the math behind paying off a house early. It's not always the best idea. Um, and really the consideration is, will this help me build wealth? Right? That's the main thing I want to focus on. Not, is it going to get rid of interest? It's not, will I lower my housing payment? It's not, will I own the house outright? It's, will this help me build wealth? Now, wealth is defined as passive income greater than expenses, taxes, and savings. Okay. Passive income greater than expenses, taxes, and savings. And so if I'm trying to build wealth, I need to be focused on that primarily. And secondarily, I can worry about how much my expenses are and all of those types of things, right? So really quick, I want to share this with you and just go over the math. So we're going to share my screen here. Awesome. Let me know when you guys can see that. And basically, I want to look at the math on this. So I have a side-by-side comparison. Okay, exact same situation, just structuring the mortgage differently, investing the equity versus just paying off the house. So on the left-hand side, we have a traditional 30-year mortgage. Conventional, it's $280,000 loan, 3.5% fixed interest rate on a 30-year note. Okay, very standard stuff. Now, here's the deal. The payment, principal and interest, is going to be $1,257 per month. Right, so that's our payment right here. $1,257 per month is what we're going to be making towards that as our minimum. Right now, let's say the home is worth $350. So I've got about an 80% loan to value. I owe $280, it's worth $350. My minimum payment is $1,257 a month. All right, so let's say I'm trying to pay this thing off early, and I free up $1,000 a month, and I start paying that $1,000 a month towards my house. Right, so I can actually draw on this. So I start paying that $1,000 a month towards my house, and I'm trying to get rid of my mortgage payments. I'm paying that off with an additional $1,000. If I do that, here's what's going to happen. Best case scenario, I pay off my house in basically 13 years, 12.85 years, right? No mortgage payment. I don't have to pay on that anymore. I still do have utilities. I still have insurance. I still have taxes, but I'm just saying I don't have to make a principal and interest payment any longer. At the end of that 13 years, I have zero payments. I also have zero cash flow being produced by my house, meaning that that house still does not make me money, right? It did appreciate, so the value went up. So it went up to $464,000. That's great, but I can't really use that for anything. It's in my house. I just paid it off, and if I'm trying to keep it paid off, it's just going to stay there. All right. So that's the main thing I'm looking at there. Now, the other thing I'm looking at is, because I was putting all of this money towards my house the entire time, I have no accrued cash flow, meaning that $1,000 per month did nothing for me other than just pay off the house. It wasn't earning cash flow. It wasn't building passive income for me. All it did was pay off the house. So at the end of basically 13 years, I have $114,000 to show for what I did. Paid off the house. That's great. It's worth $114,000 more than it was 13 years ago, but I have zero cash flow. All I managed to do was free up a $1,200 per month payment. Right now, here's the difference. Here's what I want to show you. This is what I plan on doing. This is what I share with my clients and teach them to do. Instead of a conventional mortgage, I'm going to do a first lien HELOC, a first lien home equity line of credit. I'm basically going to convert my traditional mortgage into a line of credit. It's an interest-only loan. It's $280,000. My interest rate is 4.41% interest only, meaning I only pay interest. I'm not paying principal. I only pay interest. This also is a 30-year loan. All right. Now let's look at the differences. This loan, minimum payment is $561 per month, versus on the conventional, my minimum payment is $1,257. So already on a minimum payment basis, I've already reduced my housing costs by about $700 a month. That's money that I can then keep, I can invest. And if I didn't, like if paying the house off wasn't even in the equation, it was just about housing costs, this loan gives me a lower housing cost. My home value is still $350, so I still got the same loan to value, and I'm still going to take $1,000 per month additional, and I'm still going to pay that towards my mortgage, right? I'm going to put that $1,000 every single month towards my mortgage balance. Now, the difference here is that my payoff is 13.7 years. Now, if I'm just looking at that, and I'm like, man, I want to pay off the house. I want to pay off the house. I want to pay off the house. I'm going to be like, Jerry, why would I wait an extra year? Well, the reason I'm waiting an extra year is because what I'm going to do down here at the bottom of this equation, right? So I have 0 payments after 13 years. Just one sec, guys. All right, we just got a sacred account in the mail. I had to grab that real quick. So I have 0 payments after 13 years, right? 0 payments, but after 13 years, that home is paid off. I have $2,046 per month in cash flow. And I want to explain to you why. A home equity line of credit is different than a traditional mortgage because when I pay down my equity on my loan, I can actually access that money. I can actually pull that money back out and I can use it. So if I pay my money on my extra $1,000 a month on a traditional mortgage, I can't pull that money out once I've paid it towards loan principal. That's off the table. That money's locked up. I paid off my mortgage with it. I can't get to it. The bank owns that now, right? With a HELOC, I can pull that money out anytime I need to. So what I'm saying is that I'm paying $1,000 per month towards loan principal, and I'm going to have eventually 50 grand in my equity that I could then pull out and invest. And over the next 13.7 years, every single time I have $50,000 available, I'm going to pull that out and I'm going to invest it. And by doing so, by the time I pay off this loan, I will have accumulated $2,046 per month in net cash flow. That's after interest, expenses, before my taxes, all of that stuff. That's free money. That's passive income. Okay. In 13.7 years, my home is worth $472,000. That's not as important. During that time period, though, I accrued an additional 100 grand in cash flow because every month I was getting passive income. Every month I was pulling my equity out and I was putting that into investments, and that was paying me every single month. And if I add all of that up, I made an additional 107,000 in cash flow. So at the end of this, when I've paid off my house, I have a total gain here of 230 grand between my appreciation on the home value versus what I bought it at, and also the money that I made in cash flow. And I've got $2,045, $2,046 per month in passive income coming in. So here's my question. Is it more important to have 0 housing costs and a paid off home with no cash flow and maybe make 100 grand in appreciation? Or is it more valuable to me to have $2,000 per month in cash flow, a paid off house, have made 100 grand in extra cash flow along the way, and still have the appreciation? That's why I'm saying paying off the home is not the financially wise idea. I get it. I was a Dave Ramsey guy. Okay. Get out of debt, 3 months in the emergency fund, 6 months in the emergency fund, put the rest in the stock market and pay off the house. But that's not how wealth is built. Wealth is built by creating passive income that exceeds my expenses, my savings, and my taxes. Paying off my house, all it does is lower my expenses. It doesn't even eliminate my expenses because I still have utilities, insurance, and taxes, right? So if I'm really looking at building wealth, I want to build wealth, this is my focus, then I need to be looking at how do I create passive income? Imagine like if all you did was this. All you did was this and you didn't have any other investments, which one puts you in a better spot? $2,000 a month in passive income does. Now imagine if you were doing this and you were doing a sacred account and you were doing all of the other stuff we teach. That's what this is really focused on. And the good news is, guys, this is at 13 years. Like, I'm not going to be done investing after 13 years. Imagine if I continued to use my house to produce passive income for the next 20, 30, 40 years. And eventually I moved out of it and I got tenants in there and now they're paying me rent. In addition to the rent, I'm still borrowing against the equity, making cash flow on that end too. This is the financially smart way to go about things. So I wanted to share this with you. I hope that this makes sense. I hope it helps. If this video helped you, if it made sense, if you even watched it and maybe you were skeptical and you're like, I don't totally understand the numbers, but I like the different perspective, I want you to reach out to me and you can hit me up in the direct message. You can also go to sacredaccount.com, because we're literally showing you, how do I take my home? How do I take my $350,000 home? How do I use it as a sacred account? That's really what this comes down to. So guys, thank you for tuning in today. Make sure you like, share, and subscribe. I'm going to talk to you all real soon, and I'll wrap up the video here.